Welcome everybody back to our live headline roundup today. I have a lot to talk about, so I'm going to jump right in. If you have a question as we go through the material today, go ahead and type that in the question box on the right-hand side of the screen, and Mark will be helping me keep an eye on that so that we can be sure to answer your questions or pass along your comments. So let's start with a section that I have called Making My Point. The math doesn't lie. And I have long said that the Federal Reserve will not be able to continue to raise interest rates because the federal government is not operating with a balanced budget. And the Fed is monetizing indirectly the federal government's operating deficit. Nick Giambruno, who wrote this piece for International Man, agreed. I thought it was very well done, so I thought I would share it with you today. He talks about the fact that you often hear financial analysts and politicians and media kick around the term trillions of dollars. And most of us don't understand what a trillion means. So he offers some perspective. If you earned $1 per second, it would take you 11 days to make $1 million. It would take you 31.5 years to make $1 billion. And if you earned $1 per second, it would take you 31,688 years to earn $1 trillion. So that gives you some idea that you can make $1 million in 11 days at $1 per second, but it takes you more than 31,000 years to make $1 trillion. So when politicians carelessly spend and print money, and I'm more of a stickler for the term currency, I believe money is a good store of value over time. Currency, I believe, is something that is used in commerce. So when politicians spend and print currency or create currency measured in the trillions, you are in dangerous territory, giving the magnitude of that number. And that's what the Federal Reserve has really enabled the U.S. government to do. From the start of the COVID hysteria until today, the Federal Reserve has printed more currency than it has for the entire existence of the United States. So in the last 2 years, there's been more currency created out of thin air than for the entire existence of the U.S. from 2020 going all the way back to 1776. The numbers are here. From the founding of the U.S., it took 227 years to print the first 6 trillion. But now in just a matter of months, there's another 6 trillion that has been printed. So as that has happened over that time frame, the U.S. money supply, the currency supply, has increased by a whopping 41%. So the Fed's actions, in short, have amounted to the biggest monetary explosion that has ever occurred in the U.S., probably the world. Initially, the Fed and its apologists in the media assured the American people that its actions wouldn't cause severe price increases. And we talked about that as we started these webinars all the way back in March of 2020. But as we all knew, it didn't take long to prove that absurd assertion false. As soon as rising prices became apparent, the mainstream media and the Fed said the inflation was transitory. Don't worry about it. This is just because the economy is reopening. But when transitory was obviously not the case, they then told us that inflation was actually a good thing. Of course, they were wrong and they knew it. They were gaslighting. And the truth is that inflation is out of control and nothing can stop it. And the headlines for July are that inflation has now been subdued. But I think we all know when we go to the grocery store, when we go to buy things, we know that that's not the case in reality. I believe we're seeing some more gaslighting going on now. Now, even the government's own, he says, crooked CPI statistics, I'd be a little kinder, manipulated. The way that the inflation rate is calculated has changed several times since 1980. It does understate reality. It does understate what the real inflation rate is. But even using that manipulated CPI number, inflation is now breaking through 40-year highs. So the actual situation is a lot worse than that. Now, as I have been saying, and I haven't seen a lot of really comments to really along these same lines anyway, but I've said the federal government's deficit spending and debt are really what's driving this currency creation. China and Japan are no longer lined up to buy U.S. government debt. The Federal Reserve is the lender of last resort to the U.S. government. The Federal Reserve is indirectly subsidizing deficit spending. Now, the federal government of the United States has the biggest debt in the history of the world, and it's continuing to grow at a rapid, unstoppable pace. Here's an amazing statistic when you think about it. It took until 1981 for the U.S. government to rack up its first $1 trillion in debt. The second trillion took only 4 years, and the trillions after that came in with increasingly shorter intervals. Today, U.S. federal debt has gone parabolic, and it's well over $30 trillion. We might just as well say 31 trillion. Now, if you earned $1 per second, going back to the illustration that we started today's webinar with, it would take 966,484 years. You might just as well say it would take 1,000,000 years to pay off the U.S. federal debt. And that assumes the debt stops growing. The truth is, the debt will continue to add up. This Inflation Reduction Act that was recently passed, that will do nothing to reduce inflation. You don't increase deficit spending to get inflation under control. This is a way to advance an agenda. But Congress, until they decide to cut spending, the Federal Reserve will have no choice but to continue to indirectly monetize the debt. Now, the CBO suggests that over the next 10 years, there will be a cumulative deficit of over $15 trillion, and the CBO is known for being conservative. But if we just take that number, 10 years from now, that puts the U.S. government debt with accumulated interest at probably somewhere north of $50 trillion. So G.M. Bruno, the article author, says, let me simplify this for you in 3 steps. Number 1, Congress spends $1 trillion more than the government takes in from taxes. The Treasury issues debt. They sell bonds to cover the difference. And the Federal Reserve creates currency out of thin air to buy the debt. In short, this process is nothing more than legalized counterfeiting. It's taxation without consent. Inflation is simply another tax. As you all know, you're paying more for essentials than you were a year ago. That is a tax. It's not a direct tax, but it is a tax nonetheless, because there is nothing for free, including currency creation. That's how government spending deficits and the federal debt affect inflation. Now, as long as the average person doesn't notice the rising prices, the system works well. However, once the price increases become painful enough, it creates political pressure for the Fed to combat inflation by raising interest rates. Now, he points out, and I believe this as well, that the Fed has a serious problem this time around. The amount of the federal debt is so extreme that even a return of interest rates to their historical average, now I don't know what that is, but let's just say it's 5 to 6%. Just increasing interest rates to this historical average of 5 or 6% would mean paying an interest expense that would consume more than half of tax revenues. If interest rates go back to their historical average, interest expense will be higher than Social Security spending. It'll be higher than defense spending. Interest expense will immediately become the largest item in the federal budget. Now, combine that with the fact that we have inflation at a 40-year high. Even if we get interest rates back to their historical average, we will still have net negative interest rates. We will not have interest rates that are high enough to rein in inflation. And I've said this from day one, that we need to have real positive interest rates to rein in inflation. And with the official inflation rate being somewhere north of 9%, you've got to have interest rates back at 11 or 12% if you believe those numbers are true to get real positive interest rates. Now, the reality is we probably need to get back to where Paul Volcker was in 1980. We probably need to get back to a 19 or 20% level if you want to get inflation under control. So Giambruno correctly notes that the Federal Reserve here is trapped. If you raise interest rates high enough to dent inflation, the government becomes, the bankruptcy, the insolvency of the government becomes immediately obvious. And the chart on this page I thought was very, very interesting. The red, or the green line on the chart rather, shows the level of federal debt, of official federal debt. The blue line on the chart shows interest rates. So really, since 1980, when the national debt was $1 trillion, we've had interest rates declining to the point that it actually allowed debt to accumulate to levels that are now completely unsustainable, about $31 trillion. So those two lines on the chart are almost completely inverse. As interest rates have declined, it's allowed debt to rise. So the higher the federal debt, the more difficult it is, the more painful it is, the more impossible it is to raise interest rates to levels that will get inflation under control. So Giambruno says this: the U.S. government is fast approaching the financial endgame. Inflation has to be controlled. That gets controlled by raising interest rates. But the Fed can't do that because it would cause bankruptcy. So in other words, he says it's game over. They have no choice but to reset the system. That's what governments do when they are trapped. Think about it like this. Imagine a spoiled child playing a board game. And rather than admit he is losing, he flips the board. This is what governments will do now that they are financially checkmated. They can't win, even in their own rigged game, and now are left with a choice of losing power or flipping the board. Since power does not relinquish itself voluntarily, we should presume they'll choose to flip the board. Here's the bottom line. The current monetary system is on its way out. Even the central bankers running the system can see that. So they are preparing for what comes next as they attempt to reset the system. I suspect it could all go down soon, and it's not going to be pretty, Giambruno says. Now, I don't know that it will go down soon, but I will tell you that I believe we're on this track that is unsustainable. That's why this revenue sourcing approach that many of you who are clients on today's Headline Roundup actually use, where you have some of your money in stable assets for when the reset actually kicks in, and some of your assets to protect from inflation, is really important, because we don't know when it will go down and exactly what it will look like. Now, he closes by saying the economic trajectory is troubling. And unfortunately, there's little any individual can practically do to change the course of these trends in motion. The best you can and should do is to stay informed so that you can protect yourself in the best way possible and even profit from the situation. Now, this really makes my point from a prior Headline Roundup webinar. Some of you may remember this, but we have a lot of new viewers, so I want to share this with you. I pointed out earlier this year that the Fed has really three choices. The national debt's about $31 trillion. The prior deficit was $3 trillion. There's about 126 million taxpayers in the United States, so the deficit per taxpayer is about $24,000. Now, the existing average liability per tax return is about $9,000. So it doesn't really matter what your tax liability is. If you're on today's webinar, just take a look at your tax liability, multiply it by about 2.5, and that's what you'll be required to pay just to shore up the deficit. So as an example, take a taxpayer, married, filing a joint tax return with $120,000 in taxable income. They pay Social Security and Medicare tax of about $9,000 a year, federal tax of about $12,000, state tax of about $4,000. That's a total of about $25,500 in taxes. Now, to balance the budget and eliminate the deficit, that total tax would have to go from $25,500 to about $45,500. Again, it'd have to increase by 261%. But as the note on the side of the slide here says, that does nothing to close the fiscal gap of the United States. There's the national debt of $31 trillion. Social Security and Medicare are combined, are underfunded by $150 trillion combined. The total fiscal gap of the United States, according to Professor Lawrence Kotlikoff, is about $200 trillion. So to solve these problems, each American taxpayer would need to come up with about $1.6 million on top of the changes to the tax return that you see here. So to solve these fiscal problems, each American taxpayer would need to come up with $1.6 million in addition to paying the higher taxes. Now, assuming that the average taxpayer doesn't have 1.6 million, 1.587 million to be exact, which most don't, if you were to get a loan to pay your share of the national debt, and you could get a 30-year loan amortized at 3%, you'd have to come up with another $80,000 a year to make the payments. With a higher tax liability and the additional payment for debt and the existing taxes, that consumes more than the income that your household earns. So my point in walking through this exercise is simply this. There is no way to solve this problem through higher taxes. And when you hear about a billionaire tax, and I'm not going to bat for billionaires here on today's Headline Roundup webinar, just understand that it is rhetoric and the numbers will not solve the problem. We could confiscate 100% of the wealth of billionaires, and that would cover a budget deficit for between 1 and 2 years, and it would do nothing to pay down the debt. Now, the other choice is to cut spending. Now, that's what Gianbruno said in his article. So how far would you have to cut spending to balance the budget? Let's just say about 41%. Once you cut spending 41%, you're cutting education spending, you're cutting defense spending, you're cutting Social Security spending, Medicare spending, across the board, you're cutting expenses by 41%. That balances the budget, but it does not close the fiscal gap of $200 trillion. If you were to do that, and you could amortize it again over 30 years at 3%, you'd still have to come up with another $10 trillion a year. Now, if you take a look, total tax revenues are a little bit more than $4 trillion. If you cut taxes 41% to balance the budget, you still have to find another $10 trillion to pay down the debt and fund these unfunded liabilities. The only other choice that the Federal Reserve has is to keep doing what they have been doing. That is to continue to create currency until confidence in the currency is lost, at which point we will likely see a deflationary collapse. And we're starting to see some signs of that. So the math is such that this problem really cannot be solved unless you cut spending to a draconian level, or you continue currency creation. And I believe the Fed will pivot, they will reverse course, and they will once again go back to creating currency. So we are now, I believe, on that path. I believe the Fed will reverse course. I believe we're in a recession, and we're seeing a number of rather rosy assumptions as far as third quarter growth. I don't expect that since we are, maybe halfway through the third quarter, I don't expect those numbers will hold up. I believe that we are on a path to see more inflation, and that will be followed by a deflationary collapse. The reason I'm confident about this is that this predictable pattern has repeated itself time and time again throughout history, because human behavior and the collective behavior of politicians is predictable. This time will be no different. And now just a bit about the Inflation Reduction Act. This is from the Epoch Times. House Democrats passed the Inflation Reduction Act in a strictly party line vote on August 12, sending it to President Joe Biden's desk for final approval. Now, there's a lot in the bill, but there's one thing in the bill that I want to share with you. There's $700 billion in new spending. So let's just start by saying that you don't get inflation under control by increasing federal spending when tax revenues are declining. That's not a recipe for solving the inflation problem. It's a recipe for creating more inflation. That will be the result here. What is alarming to many people is there's an $80 billion appropriation to the IRS. That is 6 times the agency's current budget. Now, there's also new climate policies. There's tax incentives for certain energy favorable behaviors. However, the $80 billion appropriation toward the IRS will go toward, quote, necessary expenses for tax enforcement activities, to determine and collect owed taxes, to provide legal and litigation support, to conduct criminal investigations. Here's another one that's a bit alarming to those with cryptocurrency interests: to provide digital asset monitoring and compliance activities, to enforce criminal statutes related to violations of international revenue laws and other financial crimes, and to provide other services. This will increase audits at a very large scale. The funds will go to hire tens of thousands of new IRS agents to further aid enforcement of the new tax rules. Unsurprisingly, the effort to expand the IRS is not popular with Republicans, who have generally opposed such efforts in the past. Kevin McCarthy, the House Minority Leader, said Democrats are scheming to double the size of the IRS by hiring an army of 87,000 new agents to spy on Americans. There's also new taxes in the bill. The most substantial is a 15% minimum tax on corporations that make more than $1 billion a year. Though the law currently sets the tax rate for U.S. corporations at 21%, many mega corporations end up paying a substantially lower tax rate after exemptions, write-offs, and tax code workarounds are taken into account. The effect this new tax requirement will have on consumer prices and workers' wages is disputed, but Preston Brashers, who is a senior tax policy analyst at the Heritage Foundation, suggested the new tax would cause prices to surge and wage growth to slow or stagnate. Medicare Part D will be allowed now to negotiate with prescription drug manufacturers, who will have no choice under the legislation but to enter negotiations or face a massive 95% excise tax as punishment. I believe this could see unintended consequences. I believe, as the article says, that while private insurers have long had the ability to haggle with drug manufacturers, such negotiations have been voluntary. But under this act, drug manufacturers would not be permitted to refuse negotiations. They have to negotiate. So what is this? It's price controls. I suggested at the beginning of the year that we would see price controls prior to the midterm elections. I believe this could be just the beginning. Now, the bottom line is, when you have price controls, if a company cannot sell their product and make a profit, they quit making the product. So I would suggest now that we will probably see many pharmaceutical companies probably pull out of the U.S. market because they don't want to operate at a loss. So the Inflation Reduction Act, I believe, will not reduce inflation. The additional spending in the bill will need to be financed by more Federal Reserve currency creation, and tax increases going into a recession do not increase tax revenues. Rather, I believe tax revenues will continue to be decreased. So that's what I have for you today. If there are some questions, you can type them in the question box on the right-hand side of the screen. And Mark, I just popped this up and I'm not seeing any questions, but I have been known to miss them. So I'll let you let me know if we have anything any questions we should answer, any comments we should pass on.
No questions at the moment. You must have wowed everyone.
Or something. Dennis, probably as far as the Inflation Reduction Act is concerned, the answer is no, in my opinion. I see another one. This comes from Michael. Michael said, any suggestions about investments to get ahead of this? Michael, I think even though metals prices have been subdued for reasons that we have discussed, I believe you want to have up to 20% of your portfolio in tangible precious metals. I believe that is still going to pay off well as all this develops. And I think we're ultimately going to see some type of a metals-backed currency emerge somewhere, sometime somewhere around the globe here. Jack has a question. What does a deflationary collapse look like? That's a really good question. Think of the 1930s. The 1930s was a deflationary collapse. Deflationary collapses or crashes occur when debt levels are too high to be paid with honest currency, and that's really where we are today. So in a deflationary collapse, we see currency disappear from the financial system. I think we're going to see a lot of currency disappear from the financial system because we have so much debt. So as this currency has been created, more debt has been created. I have pointed out in the past that around the time of the financial crisis, worldwide debt was 100 trillion. Today, that level is about 300 trillion. So as currency creation is slowed, to attempt to get this inflation under control, I believe that this inflation will ultimately lead to deflation. If you go back and listen to my interview over the past couple of weeks with Alistair MacLeod, I believe he references John Law's France in the early 1700s. And this does have, our current situation has a lot of parallels to John Law's France. In that case, you saw inflation, which led to this deflationary collapse, which saw real estate prices fall, stock prices fall, really, all financial assets lose value. So I believe that's where we're headed. So that's why I like highly rated corporate bonds or insurance-based strategies that use highly rated corporate bonds. And I like precious metals both in a portfolio to help protect you from both of those outcomes. Michael asks about gold stocks versus gold, physical gold. That's how I'm going to interpret that, Michael. Yeah, I like having physical gold in a portfolio up to 20% of the portfolio. Gold stocks, I'll interpret that two ways. There are gold exchange traded funds that track the price of gold. Those are typically not backed by anything tangible, so I'm not a big fan of those. If it's mining shares where you're buying stocks in gold and silver mining companies, those can be good investments depending on how good a stock picker you are. When gold prices go up, the price of gold mining shares typically go up exponential to gold. The same is true on the downside. When gold prices decline, you typically see mining shares decline even further on a percentage basis. So I like physical metals in a portfolio, not ETFs that track the price of metals. And mining shares, I believe, are a little more speculative, and they certainly might be appropriate for some investors. So, Michael, I hope that answers your question. Mark, I think I'm picking up all the questions here today, and I'm not seeing any more. If I'm not missing something, I think we're probably good to go ahead and conclude, just a few minutes past our customary time to do so.
Oh, you got all the questions? Great questions indeed. So let's wrap it up then.
Thanks, everybody. We'll be back live again next week.